seems like with each passing day, the rhetoric gets a little more heated, a little more chilling, right, as this trade war is now being talked about instead as a tech war.
That's right. And I'm speaking as a citizen. Part of the problem I'm having is this administration's credibility is so low that it is very hard to say, you know what, they're really onto something. Something has to change in the relationship. We've got to make the rules right. And what I am worried about is the same thing that followed the government shutdown, which is really this is just all about looking tough. And eventually here, when we've done a lot of damage to a lot of Americans and a lot of American companies and the economy, there will be a deal and the president will say, see, it's the best deal ever. And in fact, it will just be a very minor change that he can celebrate. That's what I'm worried about.
Bob, I think if you spoke to the folks at Huawei, what they would tell you is they've been anticipating something like this for a long time, which is the reason they've been making investments into an option B. Yeah. In terms of supply chain that might not involve American companies. So I think the sentiment there might be that we're settling for a longer haul in terms of those dynamics. Do you think the market is actually taking the full effect of that into account right now?
It's starting to. So my old friend Alec Young used to say, we have been in a denial rally for a while now. The denial is we're not going to have a real trade war. We all know deals are going to be made, right? Well, the reality is there is no trade talks going on right now. This G20 meeting is a phantom right now. Traders are starting to realize the underlings have to set the terms, and there's no trade talks that are actually set. And everyone's looking, saying, well, how are they going to make a deal at this point in June when they haven't even set the groundwork for trade talks now to continue? They can't just say, oh, let's pick it up where we go back, where we did before. And the market's grappling with that right now. So we have incremental growth issues. The Brexit's still there. The PMI numbers in Europe were kind of crummy. And the problem is, if you're a bull on global growth and a bull on the stock market, you have to believe that the trade issues are going to get resolved. If now suddenly you realize they're not going to get resolved, it's hard to be more bullish on the global market, and earnings numbers have to come down for the third and fourth quarters. That's what they're struggling with.
Is this what doubt looks like, though? Because we're trading around late March levels, and we've talked about this for quite a while. You were talking about what you really need to factor in if you believe that trade talks are breaking down, that earnings per share are going to be affected. It seems like we're nowhere near there.
I'll tell you where you need to go. Cashin and I went through this 3 weeks ago. 2,600 is a typical number that people will use on the S&P 500 right now. We're 50 points away from the 200-day moving average. But if you simply say, let's assume earnings are going to be flattish this year, not up, flattish, and you lower the multiple because global growth, you have a lower multiple. So instead of 17 times forward, you bring it down to 15. You get into the 25 to 2,600 range very easily. So assume flattish, assume lower multiple and lower global growth, and you're 200 points lower, 2,000 points lower on the Dow and the S&P 500. And if you start saying, no, wait a minute, we're going to have a global recession, and you have negative earnings growth, well, now you're 2,500 and below. So it's not hard to get to these numbers. And you're right. The bulls keep saying, hey, what's the worry? We're 4% from historic highs. You guys are making up stuff. We're not making up stuff.
The bulls say that, and Henry, they say that the whole thing could be undone by a tweet. Right? And you could be off to the races, literally, with one tweet.
Yes. If the economy the global economy starts to pick up steam again, some of the early recessionary warnings, yellow flags that we're seeing start to suddenly change, everything goes green again, yes. But sure, you'd have a short-term rally, but Bob, I want to thank you. Usually it is me who is putting out the reasonable ways that you could have a severe market pullback, and then people throw the fruit at me on Twitter, so
with the market this high, the risk is to the downside. And it was Cashin who used the famous phrase now that we're one tweet away from a new high and one tweet away from a 10% correction. That's actually what he said. And he's right. It sounds crazy, but that's really what it's and it makes everybody nuts. It makes the market nuts.
Our data desk is looking at names that are in a bear market, so, quote unquote, down 20% from the high. Apple, NVIDIA, Cat, Boeing, Intel, Halliburton, Macy's, Nordstrom. So the markets realize some of this already, right, and price some of it in.
That's right.
You don't disagree with that?
No, I don't disagree with it at all. And it's not like everything is shut down, to John's point. The IPO market's still open. Some companies are still doing well. So to Bob's point.
So everybody hides in defensive names and, let's buy consumer staples. And I got news for you. If there is a real, true global slowdown of notable proportions, forget about it. The consumer staples names are too high. Their earnings are too high for them, too. And they're going to come down. So you say, how do you get to 2,600? That's how. Yes, we have taken down retailers 20% for Kohl's this week alone. We've been crazy. But there's whole pockets of the market that are still at that just down 2 or 3 or 4%. And a global recession will bring those numbers down as well. That's why this is a very risky game to play, to let it go on and on for a long time. The retailers were really, Home Depot, you read Kohl's, what they were saying this week, they were not good. And Best Buy said, we're not going to tell you anything about whether we have a third tranche of earnings. We're going to assume, tariffs. We're going to assume that this doesn't happen. And here's our guidance based on the idea that this other tranche doesn't actually happen. And the guidance was fabulous. And the stock was down 4% because the market looked right through that. Yeah.